Recently, multiple banks have either failed or have shown significant signs of financial distress. Will the recent turmoil with banks affect the economy or cause the stock market to plunge? Probably. But there are securities you can buy now that have very little risk, yet have the greatest potential for capital gains. Bank troubles may not be over. Recent market turmoil increased the cost of funding banks. The recent string of bank losses and problems may indicate wider problems. Interest rates have been rising rapidly, causing long-term bond prices to decline. The bank formula for profits when interest rates were low was to buy long-term bonds to earn more yield while paying little or no interest on deposits. This formula worked when interest rates were extremely low. But to combat inflation, the Federal Reserve quickly increased interest rates, causing long-term bond prices to decline. Further, customers now had many ways to earn a higher yield with little or no risk, so banks were forced to increase their interest rate on deposits. This created financial distress for the banks. Bank customers with large uninsured deposits became fearful that the banks may go under, so they withdrew their money, forcing banks to sell their bonds at a substantial loss. Banks have started failing. In early March, Silvergate Capital announced it would cease operations and liquidate its assets after a bank run. The troubles experienced by Silvergate Bank demonstrated how traditional banking risks, such as lack of diversification, aggressive growth, maturity mismatches in a rising interest rate environment, and sensitivity to liquidity risk, when not managed adequately, could combine to lead to a bad outcome. Also in early March, rumors were spreading that Silicon Valley Bank may fail. Its stock plummeted 60%. Then it failed after a bank run. Bank regulators and the FDIC took control of the bank. Investors started to dump stocks of other banks. Regulators seized Signature Bank on March 12th. Credit Suisse, a major European bank, kept declining, then finally collapsing. Consequently, Swiss regulators arranged for UBS to take over Credit Suisse, which was one of the country's biggest banks, founded in 1856. Deutsche Bank shares tumbled after the cost of insuring the lender against default rose. But the bank, founded in 1870, survives. Questions are still swirling about Charles Schwab, though most of its deposits are insured, so no bank run that would threaten its stability is expected. Because many banks have suffered from interest rate risk, the Federal Reserve set up a short-term lending program to restore confidence in the banking system, allowing banks to borrow against their treasuries and mortgage-backed securities at their face value, rather than their much lower market value. Consequently, many banks have borrowed much more money. However, even if banks maintain liquidity, their profits will suffer, since the value of their long-term bonds will remain depressed as long as interest rates are high. This may cause more banks to fail later. Higher interest rates and higher debt always slows the economy eventually. The World Bank has already projected that economic growth will slow. Because there is greater risk that other banks will fail, demand for downside protection is increasing. Credit default swaps are also becoming more expensive, which is another indication that defaults may become more common. The global banking crisis and the Federal Reserve's decision to increase interest rates by another 0.25% only worsens the situation. Companies with the weakest credit may struggle to get refinancing. Thus, zombie companies kept afloat by easy money in the past may start to fail. Expectations that more businesses will fail is revealed in the credit spread of junk-rated bonds. This graph shows the increasing yield difference between B-rated bonds and CCC-rated bonds, which are considered junk bonds. Prices for CCC-rated bonds are declining because the risk of default is perceived to be increasing, which often happens when the economy enters a recession. More company bankruptcies may also cause some shadow lenders to fail, which may cascade throughout the economy. Another problem for banks in the economy is commercial real estate loans. Regional banks provide the bulk of these loans, which are then repackaged into complex financial products for investors, and the outlook for this industry appears stark. Commercial real estate is the lifeblood of the lending business for regional banks. The demand for office space has plunged in cities across the United States, accelerated by the pandemic. The bigger the city, the larger the decline, adding up to a 12% office vacancy rate in the United States from 9.5% in 2019. Remote and hybrid work, layoffs, and higher interest rates further increased office space availability. The debt on those office buildings will soon come due. More than half the $2.9 trillion in commercial mortgages will need to be renegotiated by the end of 2025. Local and regional banks are on the hook for most of these loans, nearly 70%. According to estimates from Bank of America and Goldman Sachs.
Often, economic booms and busts occur because of the debt cycle.
When things are good, people become more confident. They borrow more money. This stimulates the economy, causing it to heat up. The Federal Reserve responds by raising interest rates, which makes debt more expensive. Eventually, the debt must be paid back, so the economy slows, which may lead to layoffs. This causes the economy to contract further. Then the Federal Reserve repeats the cycle by lowering interest rates, but no matter how low the interest rates are, it still takes time to pay off debt, requiring most people to spend less. To summarize, higher interest rates are slowing the economy. Credit is more expensive, reducing buying power. Borrowers will allocate more of their funds for reducing debt, thereby reducing spending. More businesses will fail. Savers are moving money from bank accounts to money market funds. Consequently, banks have less money to lend. Contracting credit means less investments and spending. The multiplier effect will slow the economy faster, causing a recession. The stock market will decline. So, is this a Minsky moment? Minsky moment describes the long bull run when it becomes clear that asset values are unsustainable and an epic crash looms. The term was coined by the economist Paul McCauley in 1998 based on the financial instability hypothesis of the economist Hyman Minsky. His theory holds that over a prolonged period of prosperity, investors take on increasing risk until lending exceeds what borrowers can repay, so they start selling assets, leading to plunging markets and creating a cash crunch. If the economy does enter a recession, then the Fed will reduce interest rates to stimulate the economy, which will cause long-duration bonds to skyrocket in price. U.S. Treasuries and bonds based on U.S. Treasuries will also benefit from the flight to safety that often occurs when there's economic turmoil. Some of the best ETFs that will benefit include the PIMCO 25+ year zero coupon U.S. Treasury ETF, the Vanguard Extended Duration ETF, and the iShares 25+ year Treasury Strips ETF. This is a 5-year graph of these securities. The prices for these securities on April 6, 2023 are shown below the graph. The prices have declined substantially because interest rates have been rising rapidly, which is what happens to most bonds, especially with bonds of long duration. However, when interest rates decline, then the prices of these securities will skyrocket. I explained how interest rates affect bonds with long duration in another video. The link is provided in the description. Notice that right after the start of the COVID-19 pandemic, interest rates dropped to near zero. This caused the PIMCO and the Vanguard ETFs to zoom in price. The displayed prices are for April 24, 2020. The iShares ETF was only created afterwards, which is why you see 0% here for that security. I will soon release another video discussing these securities in detail and why their prices are surely going to skyrocket. With banks failing and considerable economic uncertainty ahead, now is the time to buy long-duration bonds based on U.S. Treasuries. Buying Treasuries or ETFs based on U.S. Treasuries eliminates credit risk, which is a major concern in economic downturns, which is why Treasuries and funds based on Treasuries benefit the most from this flight to safety. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thismatter.com for more than 850 in-depth fundamental tutorials in personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.